In this week's video, we'll review the latest charts, data sets, and studies to help us answer the question: is the stock rally broadening out, ushering in the return of economically sensitive leadership? Just the summary slide from June 25th. The two boxed bullet points in this week's video, we'll see if they still apply as of July 9th. It's a daily chart of the airline index, XAL, relative to the S&P 500. This is 2020 here. This is the March low in the S&P 500. Right here, we're looking at the ratio of the equal weight S&P 500 relative to the S&P 500. This is the airline index on top relative to the S&P 500. The airline index makes a stand on a relative basis back in May, and you can see from that point RSP outperformed SPY inside of this box here. Similar situation here. The airline index relative to the S&P 500 makes a stand in the same general area, outperforms after that. RSP also outperforms SPY for several months. We're back to the same area. This is late in the session, 3:48 p.m. Eastern Time on July 9th. Doesn't mean we're going to hold here. It's just telling us to keep an open mind that economically sensitive sectors could begin to lead again, as they did here and as they did here. And this is the same basic concept that we tweeted about during Thursday's session when the S&P 500 was struggling in a big way. On a relative basis, even though most things were falling on Thursday, there were some signs for hope. We're going to focus on the top 4 bullet points from last week's summary slide. When we look at the S&P 500 a week ago, this is being recorded on July 9th. This chart is as of July 2nd. Fairly easy to understand that the big picture still remains constructive from a trend perspective when the S&P 500 prints a new all-time high. Notice this trend line here from the low captures every single intraday low between point A here and point B here, which is the highest high. This chart is dated June 18th. If we drew a similar trend line from the March 23rd low here, and we captured the highest high here and this low here, meaning we've captured all the lows between point A and point B, things looked a little bit vulnerable on June 18th. We're below this upward sloping trend line. This somewhat looks like a failed bullish breakout above this level here and then a reversal. That's the chart in front of us on June 18th. But looking at the June 18th chart, if we go up and make a higher high, this trend line has to be redrawn to capture this low here. And this is what that looks like a week ago as of July 2nd. We're above this longer-term consolidation box, and this is starting to look like a successful bullish breakout a week ago. Next, we're going to walk through some important psychological concepts. At the end of the video, we will double back to this chart and see what it looks like as of July 9th. You can pause your video player here to read these tweets. Someone on Twitter asked, "Why do you never really make a decision about anything? You seem very, very indecisive." That's a very, very fair question, and one that we can answer very, very simply and with a high degree of confidence. Our investment allocations, our pie charts, is where we take a stand based on past odds. So the pie chart or our current investments are based on the facts that we have in hand as of the day of this pie chart. So in our case, we're always taking a stand with our clients' funds and our own funds as well. In investing and trading, it's extremely important to understand there is a big, big difference between the past and the present. So at the end of the day, are we allocated properly based on the facts that we have in hand today? And under certain market conditions, this pie chart can be built with a high level of conviction, if that's what the data says. In a more indecisive market, the pie chart can be a little bit more mixed. And in a bearish market, it can be slanted towards defensive investments. And all of that can be done very, very confidently based on facts. The future is another story. The past is a sunk cost. It's yesterday's news. So when we wake up every day, this pie chart really should not impact how we interpret new data. The name of the game every day, we want to wake up every single day and make the best next decision possible. And to do that, we need to forget the past. We need to objectively assess current data. And to do that properly, you have to push your ego aside. Being over here is quite a bit different than trying to construct a narrative to defend this pie chart. And in order to make the best next decision, we have to think in probabilities. What happens if the market goes up? What happens if the market goes down? What happens if the market goes sideways? And what are the odds for all three of those cases? And to make the next best decision, we have to remain flexible and we have to remain open to a wide range of outcomes. We can build this pie chart confidently based on the facts that we have in hand. But when we wake up the next day, it's extremely important that we stay in the now. Now let's look at a handful of charts during the session on Friday, July 9th, focusing on these top 3 bullet points from last week's video. FDN Internet Stocks relative to TLT bonds Friday morning, July 9th, 10:12 a.m. Eastern Time. When the market came down here during Thursday's session, the S&P 500 and the broader market sold off on Thursday of this week. What you were hoping was that this ratio was coming back to somewhat retest this breakout here and that it would hold. You're also hoping that the ratio will hold above all of these areas, these indecisive areas where we had gaps in the past. Thus far, that appears to be the case, and that appeared to be the case as of the close on Thursday, telling us to keep an open mind about better than expected outcomes on Friday. Part of staying in the now is assessing current probabilities. What are the odds here that this ratio eventually goes on and makes a higher high and breaks out of this period of consolidation? Given we held here, given we held above these levels here, and given that we already have exceeded this high over here, those odds appear to be pretty good. It hasn't happened yet, but we can get ready potentially for a breakout in this direction. The momentum profile also says we should be open to a push into this area here. Notice here when things are going well, momentum, Williams percent R, never gets down into this area here. This is somewhat of a momentum failure, a bearish momentum failure. The market didn't have high enough bearish conviction in the ratio to push it into these areas here. That's not the case here, and that's not the case here. So between mid-February and let's say early May here, you can see price action also changed. If we come over to the present day, we're starting to look a lot more like this favorable momentum profile where the ratio continued to rise for a time. The objective is not to predict, but to assess the odds of moving into this area down here or moving into this area here. And all we can do is assess those odds to the best of our ability at the time we assess them. And then we wake up the next day and do it all over again. Because the objective is to make the best next decision. Also noteworthy here, notice how we were able to recently get into overbought territory here where my cursor is. That's not the case on this move here, and that's not the case here. Indecisiveness may not be a lot of fun, but an indecisive market is an indecisive market, and it's only indecisive on this time frame, and this impacts our next decision. It doesn't discount the fact that we have bullish trends back here. We're already allocated to handle those bullish trends. That's in the pie chart. Wouldn't be particularly helpful here relative to our next decision to take a decisive stand when the ratio and the markets are indecisive. We have to deal with the markets as they are, not as we wish them to be. Very, very similar story here. This is Tech F-Tech versus TLT bonds during Friday's session. Once again, on Thursday, what you're hoping is that we'll come back and tag this trend line here. What once acted as resistance may now act as support. Unlike FDN TLT, this ratio has not yet made a higher high. But as long as we hold here, and as long as the momentum profile looks as it does as of Friday's session, we have to be open to the ratio moving out here. We'll see how it unfolds in the coming days and weeks. Typically, a stock-bond ratio is going to help us with bull-bear probabilities for the broader markets. If we move up here, that tends to be good for stocks. If we move down here, that tends to be a negative for stocks. A chart like this is used more for asset allocation decisions. QQQ has been strong recently relative to SPY, but it still has a lot to prove. The last time it made a high was in February of this year. We've come back to this downward sloping trend line as of Friday's session, and we're back to the 61.8% retracement. If we look at the very long-term trends in QQQ SPY and momentum profiles today, we have to be open to QQQ resuming its leadership. But we still need to see some additional improvement on this chart. Notice QQQ relative to SPY is all the way back to the 61.8% retracement. If we look at the equal weight version of the S&P 500, we're hovering around the 38.2 and have not made it back to the 50 yet and still have to deal with this downward sloping trend line. The outcome here can help us with asset allocation decisions in the coming days, weeks, and months. If we back out and look at the same chart on a longer time frame, we can see we broke this trend line here. That's step one. This is a lower high relative to this high. Step 3 would be making a lower low relative to this low here. That's happened. This is telling us here this somewhat looks like a failed bearish breakdown if we can move in this direction. This line here and this level here is important, as is the 38.2, the 50, and the 61.8, and the downward sloping trend line. We've got a lot going on here. On a relative basis, this is still indecisive. The bigger picture and the prior trend tells us to be open to a breakout in this direction. But from an asset allocation perspective, we don't want to go crazy with tech just yet. The opening portion of the video, or this portion of the video, was recorded during Friday's session. Now let's shift gears and look at some breadth charts and other charts as of the close on Thursday evening after the big sell-off in the markets. There's no need to re-record that if we're able to assess the probabilities objectively on Thursday evening. The table on your screen was compiled by LPL Research. The S&P 500 recently had 7 consecutive daily closes that ended in a new all-time high. As LPL shows you in the table, something similar has only happened a handful of times dating back to 1950. 3 months later, the S&P 500 was higher in every case. The average gain was roughly 4%. 12 months later, 100% of the cases were higher. The average gain was 11.1%. The median gain was 11%. From a money management perspective, we wanted to know what the maximum 6-month drawdown on the S&P 500 looked like walking forward from these dates here. The answer is shown on the right side of your screen. Worst case scenario, hypothetically, the market would backtrack to roughly about April 1st levels, somewhere in the neighborhood of 40-50. But in the other cases, the drawdown was relatively muted. This chart was compiled using this table. The average 6-month drawdown was 1.77%. The median drawdown, even more shallow, 1.26%. Simply telling us to keep an open mind about better than expected outcomes looking out 6 months. Once again, the table on your screen was compiled by LPL Research. The S&P 500 recently completed a 5-month winning streak, also relatively rare. It's only happened a handful of times. These dates here, month end, shown on your screen. Walking forward from these dates after the 5-month winning streak, 1-year performance Very, very satisfying. The average gain was 12.8%, the median gain 11.4%, and maybe more importantly, 96.2% of the cases the market was higher. In the one case where it was lower, it was basically flat. Hypothetically, if we followed a similar path after our 5-month win streak, what type of drawdown could we expect relative to the historical drawdowns? The average 6-month drawdown was 3.9% in the historical cases. The median drawdown just a little bit over 2%. Looking out 1 year, still relatively muted. The average drawdown less than 5%. The median drawdown still at 2.05. This chart here shows us what this figure here, and this figure here would look like hypothetically from month end June 2021 if we experienced a similar average or median drawdown. Hypothetically, we might backtrack to roughly 4,200 or somewhere between 4,100 and 4,150. Remember, we don't use these to predict anything. They're just simply a reference point. If we backtrack into these areas here relative to the historical cases, that's really not particularly abnormal. But if we move into this area down here from an average and median perspective, we're starting to drift a little bit from the script. The same concepts apply to this chart here. The market had a rough day on Thursday, July 8th, so let's look at some of the damage on the breadth charts that we've been following. NYSE stocks greater than our 200-day exponential moving average. You can see a change of character here relative to what we've seen looking backwards to November of last year. Classify this as somewhat of a pay closer attention type look, but we do have plenty of data to somewhat offset that. This is NYSE common stock only, new lows as of the close on Thursday, July 8th. You can see in 2010, this is the massive rally here in the S&P 500 where my cursor is after the low in 2009, and this is a relatively sharp correction in 2010. You can see the NYSE common stock only new lows started to accelerate in here in the relatively early stages of the correction. We don't really have anything like that as of July 8th. We'll learn something either way. Similar situation here, S&P 500, bottom of the screen. This is the correction in 2004 after the big move in 2002, 2003 in the S&P 500 index. Here's the correction here in 2010. You can see in both cases, S&P 500 greater than our 200-day exponential moving average drops below all 4 of the lines shown on your screen. Here's the correction in 2010. You can see here we drop below all 4. Really haven't seen anything alarming here. We know from past videos this data can change very, very rapidly. You can get sharp drops. We may see that soon, but we just don't have it yet. And as we've discussed in past videos, the blue and orange lines show us where things started to get a little bit dicier in the 2004 correction and the 2010 case. Here are the two 2004 levels here, 2010 levels here. This is where we stand as of Thursday's close. Also noteworthy, as of Thursday's close, we're well above the level that we saw as recently as June this year. This may drop fast, it just hasn't happened yet. S&P 500 stocks greater than their 20-day exponential moving average. Some weakness here, no question, but nothing particularly alarming at this point. All of these breadth charts are as of the close on July 8th. NYSE stocks greater than their 50-day exponential moving average. This one looks a little bit more concerning, and that would be a common theme. The broader the index, the more concerning the data tends to look. This purple line here shows the level as of the close on July 8th. You can see, in terms of recent history, we're getting down to levels here where we either need to hold relatively soon or things will probably get worse. And the thing that might be concerning here is we're down at this level here, and we're this weak, and the S&P 500 has really not fallen very far yet, telling us it's possible this is a vulnerable state here with this weak data. Probably fair to say we would classify this as a glass half empty data set, and the fact that we're still registering a respectable amount of new highs as of July 8th, this is probably closer to the glass half full. You can see we're really not doing anything abnormal relative to what we've seen in the rear view mirror. NASDAQ breadth momentum oscillator, this is for the NASDAQ composite, well above the blue lines and the orange lines. Similar indicator here for the NASDAQ composite. This one, however, is tied to volume. Once again, these are the alarming levels here where things got a little bit more dicey in 2004 and 2010. Right now, it just doesn't look that bad, and it even looks better than what we saw earlier this year in 2021. Like most of these breadth charts, things can change very, very quickly, so we'll keep an open mind about what it looks like after Friday's session and how things evolve in the coming days. Similar situation here. Now we're looking at a breadth indicator for the more narrow NASDAQ 100. Think the triple Qs. Breadth momentum just doesn't look that scary at this point as of July 8th. Same can be said for NASDAQ 100 new lows as of July 8th. S&P 500 breadth momentum oscillator above both blues and both orange. We'll cover several of these charts. The concepts are similar across all of them. Dow up down volume, S&P 500 here. This is the correction in 2004 after the big rally in 02-03. Here's the correction in the S&P 500 in 2010. You can see in both cases we break the trend line from this low here relatively early in this pullback in the S&P 500. Same situation here. This is the March 2009 low in the S&P 500. This is the highest high here. This trend line breaks right here, near this line here, and you can see that's relatively early in this pullback in the S&P 500 in 2010. How does the same chart look after Thursday's session? Better, worse, or about the same? On a multiple choice test, we would probably choose better. However, you can see some deterioration here. This is the March 2020 low in the S&P 500. That's where the trend line starts. You can see we have broken that trend line. That's a little bit alarming. What we don't have yet is somewhat of a dislocation look as we did here. Somewhat of a dislocation look as we did here. That may come very, very soon, but right now we're well above this low here, well above this low here. Very, very similar concepts here. This is NASDAQ 100 up-down volume. Break here. A similar trend line from the low in 2020. We look a lot better today than we did right here or right here. These charts are for the NASDAQ 100. How about the broader NASDAQ? Similar situation here. You can see we get a trend reversal, S&P 500 here. We get a trend reversal, S&P 500 peaks. Just don't have a lot of deterioration or anything that looks like a break of even the more recent trend here. This is July 8th, 2021. S&P 500 up-down volume. We get the trend break here. Here's your correction in the market. Get a trend break right here. You can see it's in the relatively early stages of this pullback here in the S&P 500. The same chart today, looking a little bit more vulnerable, but the trend is still intact as of July 8th. We get down into this area here, we'll learn something about bearish probabilities. If we make a stand from this vulnerable look, as we did here in 2020, we'll learn something as well. Back to the portion of the video that was recorded during the session on Friday, July 9th. Remember, this was the look of our chart a week ago on July 2nd. Here's the look during the session on July 9th. Notice Thursday's sell-off came back to the upward sloping trend line and held. It also came back to the consolidation box. What once acted as resistance may now act as support, telling us during Thursday's session to keep an open mind about better outcomes on Friday. That's not a prediction. That's an assessment of the probabilities, allowing us to sit on our hands at the close on Thursday, respecting that we needed to see some improvement in the coming days. This is the breadth data on Thursday at 10:20 a.m. It's ugly. This is concerning an expansion in new lows relative to new highs. Very, very lopsided here, 127 to 29. So when we're looking at the breadth charts and recording the video on Thursday evening and talking about those breadth charts, what we're hoping is that this data is going to improve during Friday's session. And it did improve in a significant way, at least intraday. Compare these numbers here to these numbers here, 106 to 4 and 29 to 127 to 68 to 24. A lot of improvement here, 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 and here as well. Keeping in mind that this is intraday data. There's a reason why in these videos we say all of the comments that we've made are based on the facts that we have in hand today. Because after 4 p.m. today, all of this becomes a sunk cost, and then Monday morning we have to shift back to the right side of your screen. The bullet points from last week's video, really all of them still apply. Some of the probabilities in this area have improved this week, and that's already baked into the cake as of the close on Friday. And if we're to wake up Monday morning and make the best next decision next week and in the coming days and weeks, we all know that we have to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.